So welcome back everyone. In this new lecture we are going to start with probably the last topic of our corporate valuation, from question number 28 to the last question like 43. We are going to discuss the same concept, that is economic value added, and it won't take much time to cover up question number 28 to question number 43. Question number 44 is almost the same and easiest one, and most probably in another 1 or 1.5 hours we will complete the chapter. So let's come up and discuss briefly about the economic value added. Economic value added. Understand the word value added. Value added itself means that we are going to compare two different values and we are going to find out how much is the extra value that has been added to the stakeholders of the company. And the stakeholder means equity and debt both, not just the equity. Okay. And a simple explanation for this is like, understand now, let's say for example this is a company, right? And so this is a company. The very first thing that the company needs fund, and company will ask for mostly two types of stakeholders, that is equity and debt, loan, debt, etc. Now let's assume that this party has given 60 crore rupees and debt holders has contributed 40 crore rupees. So in total the company has 100 crore rupees of the funds. Obviously these funds does not come free of cost. Company has to give them return in terms of cost of equity and cost of debt. Let's say for example the interest rate on debt is 10% and the dividend on the cost of equity is 15%. So 15% will be the cost of equity, 10% will be the cost of debt, right? So how much is being expected by the each stakeholder? Equity shareholder is expecting somewhere around 60 into 15%, that is 9 crore rupees every year in terms of dividend and capital appreciation. And debt holders are also expecting an interest of 4 crore rupees. But the benefit on the debt holder side is that 4 crore rupees which the debt holders are going to get is tax deductible. So practically speaking, 10% is the pre-tax rate. And if we consider the tax rate as 30%, so the after-tax cost of debt comes to 7% only. And 7% of the 40 is just like 2.8 crore, right? So 9 crore expected by the equity holders, 2.8 crore expected by the debt holders after tax comes to 11.8 crore on 100 crore rupees. And that makes the total cost of capital as 11.8 crore. What is this 11.8 crore, sir? I will just calculate it once again in front of you so that you will get an idea. Equity holder, debt holder contributed 60 and 40. This is expecting 15%, that's 9 crore. This is expecting 7% after tax because 4%, the 3% will be tax saving to the equity shareholders as well. So 2.8. So I'm calculating this as after tax cost of capital for 100 crore. Can I say 8 crore, 11 lakh, 11 crore 80 lakh is what they are expecting. So a plain and a simple meaning is, if we are giving you money, you are supposed to earn. By using this money, you are supposed to earn a minimum of 11.80 crore for us. That earning which the company will, when the company will put this money in the market and they will get the return, that earning is called as EBIT, earning before interest and tax. And that is 1 minus tax. EBIT 1 minus tax. This is also called as net operating profit after tax. Net operating profit after tax. We need to make sure that we only keep the profits for equity and debt holders, and that too after taxes. So that's why 1 minus tax, no PAT. And that has to be minimum 11.8 crore. Let's say for example, the company has put the money in the market and they have earned EBIT of, let's say, the EBIT of the company is just let's say around 15 crore rupees or 20 crore rupees is the EBIT that the company has earned. If we deduct the tax out of it, we will get the net operating profit after tax, which comes to around 14 crore rupees. Am I right? Yeah. So what was the minimum expectation of the stakeholders? 11.80 crore. What is exactly they have earned for both these people? 14 crore. So what is the difference called as? 14 crore minus 11.8 crore comes to 2.2 crore. This is called as economic value added. This is what the economic value added is. How much value you have added? 2.2 crore over and above our expectation. It's very simple, sir. How much we are asking you to earn and how much actually you have earned. If you have earned more than what we are expecting, that is the economic value added. Economic value added is nothing but actual earnings for these stakeholders minus expected earnings. You just need to make sure that these earnings are after tax and plus applicable for equity and debt holders both. So you should not take earning after tax. It should be EBIT before paying anything to the debt holders. And it's not about the cash flows, it's about the earnings. Do not consider the cash flows. Forget about those workings now. Earnings. What will be the formula now? It's very simple, sir. Actual earnings is net operating profit after tax, or you can say EBIT 1 minus tax. And how do you calculate the expected earnings? It's nothing but the WACC multiplied by the capital employed. So, no PAT is EBIT was 20 crore, right? 20, 1 minus 0.30, WACC was 11.80%. Can't I say that 11.80% is also the weighted average cost of capital? This is nothing but the weighted average cost of capital. If you try calculating WACC, it's cost of equity into weight of equity plus cost of debt after tax minus weight of debt. So simply speaking, cost of equity was how much? 15% into 0.60 plus 10, 1 minus 0.30 into 0.40. It will come to 11.80%, 80%. So 11.80 into 100. So that's 14 minus 11.80. That's 2.2. This is the economic value added. A simple and a short formula for economic value added is this. EBIT 1 minus tax, which is the actual earnings, minus the expected earnings. Whatever is the extra that you have earned. Or we can say this much you have added on 11.80. We expected this much only, but you have earned an extra for us. That is the value added over our expectation. That's what we have to do in the coming questions. But there will be some variety. It's not that easy. There will be some variety in most of the questions. Like patents, we will be adjusting things for patents and bad debts provision, and we can say what else can be there. It will be preliminary expenses, or we can say prepaid expenses, which has been already deducted. So mostly it will be like this. Okay, sir, let's start from the easiest question to the difficult one. Question number 28 in front of you. Okay. Constant Engineering Limited has developed a high-tech product which has reduced the carbon emission from burning of the fossil fuels. A good story. The product is in high demand. The product has been patented and has a market value of 100 crore. And this is worth, which is not recorded in the books. It is not recorded in the books. It should have been recorded in the books. The net worth of the Constant Engineering is 200 crore. Net worth. And the long-term debt is 400 crore. Net worth belongs to equity shareholders. 400 crore belongs to debt holders. The product generates a revenue of 84 crore. And now 84 crore in this question is EBIT 1 minus tax. Now you will say that how this is possible? Obviously this is not possible. Revenue in itself means sales, not the profit. But no other information is given in this question. If the sales are given, you should give the expenses also and the tax rate also. If nothing else is given, we will assume this 84 crore as EBIT 1 minus tax. Otherwise we cannot calculate the EVA. We cannot write down in the answer that because the data is not given, we are not going to calculate it. No, you will have to take the assumption and give proper note of it. The rate on 365 days government bond is 10%. That's risk-free rate, I think. 10%. Bond portfolio generates a return of 12% per annum. They want to say it as 12% market return. The stock of the company moves in tandem with the market. What do you mean by this? I think you should be better. Beta is 1 because it is moving exactly in tandem with the market and the market's beta is 1. So beta is 1. If the beta is 1, the market return and the stock's return will also be equal to 12%. The cost of equity now is 12%. Cool. Economic value added of the company is to be found. Okay, so net worth is, come to this point now. It's very simple. First of all, let's find out the EVA. EVA is nothing but income earned, which is 84 crore in this question after tax. Cost of capital minus total investment. Total investment constitutes three things: net worth of 200 crore, long-term debt of 400 crore, and this patented value of 100 crore, which is not booked in the books. So once you put an entry of patents, you will debit the patents, which will go on the asset side, and credit the capital reserve, which will be a part of the equity. So again, it is the equities part. So what we can say is 200 is the net worth, 100 is the patented right. Both of them contributes to equities value. Patents are for the owners of the company, which is the equity. So 300 crore is the equities value and the debt is 400 crore. Total 700 crore. Okay, sir. Understand. Equity 300, debt 400. Now this is the weighted average cost of capital. Since you said that equity is moving exactly in tandem with the market, that means equities return and the market return will be same, which is 12%. And the next thing that they gave here is the 10% cost of capital. 10% government bond rate. Now I'm pretty much not satisfied because this might confuse you that long-term debt is 400 crore and the bond is 12%, not the market. But no other options are there in this question for you. So you will have to assume the bond rate or the debt rate as 10% and the market rate as 12%. So 10% without tax. So we are not deducting the tax here. Otherwise we would have 400 by 700. It's very simple. This is the weight of the debt and this is the weight of the equity. So we calculated the weighted average cost of capital at 10.85%. Now understand, this is the invested capital. The expectation from the investors is 10.85% of the 700 crore. Which comes to around 75.995 crore and actual earning is 84 crore. So they expected us to earn this much and we have earned actually this much. So 8.05 is EVA. It's a good sign. If the EVA is positive, that means you are earning more than expected. So in this question, you learned about how to treat the patents. There will be more questions with this formula, so don't worry about the formula. You learned about the patents, okay? Coming over to the next question now. Question number 29 is easier one, so you will take it as homework. Question number 30, have a look. Compute the economic value added now. Income, revenue from the operation, expenses, profit before interest and tax. So this is important for us. Interest, profit before tax, tax and profit after tax. Balance sheet. So if we go in the balance sheet, this much is the equity holders revenue, that is 1600 crore. And this much is the debt holders part, that is 200. So total capital is 1800, equity plus debt. Am I right? Yes, sir. What else to the question? Cost of debt is 15%. Good. Cost of equity is 12%. Tax rate is 13%. 30%. That means 1 minus 0.30. What will be the after tax cost of debt? 10.5, I think. 10.5% is the after tax cost of debt. Cool. Bad debts. Now understand. Bad debt provision of 40 lakhs is included in the indirect expenses and 40 lakhs reduced from the receivable in current assets. Understand that this is a treatment which is not an actual expense. It is just a provision that we have made, and that provision is a non-cash expense. So one thing that will be one reason that we do this is the tax benefit. Once we add the provision for bad debts, we get the tax benefit on this 40 lakhs. But this is a non-cash expense which has unnecessarily reduced our profit. So what should we do? We will add back this amount to the profits to make sure the profit is presented at a correct value. 40 lakhs will be added. Okay. Apart from that, the same amount has been reduced from the current assets. Once you add that amount back to the current assets, it will impact the equity capital, the reserves and equity capital also, because the balance sheet has to match. If the profit will increase, it will again come to the reserves and surplus only, na? So this 600 will be increased by 40. So the net capital will be increased by 40 lakhs, which will make it 1840. The capital invested is 1840. There will be a double entry, right? Debit and credit. So the credit will go to the funds, reserves and surplus. This is already a credit balance. And again, if you will do the credit balance again, so 1840 will be the total capital investment. Second part is increasing the profit. So what are you going to do? I will just show you. 800 is your profit before interest and tax, and bad debt provision is included in that. So what will you do? It's very simple, sir. EBIT, I will just show you two different treatments. EBIT plus bad debts provision, or let me just write it like this. 800 plus 40, 1 minus tax, or 800 1 minus tax plus 40. Which treatment is right? The second treatment is right, because in the first treatment, what are you doing is you are ignoring the tax benefit on that 40 lakhs of interest non-cash expense. Do not ignore that. Tax savings on 40 is real, but 40 lakhs itself is a non-cash expense. So this treatment will be wrong, because we will ignore the tax benefit on 40 lakhs of the expense. Why do you want to pay more taxes? 840 minus tax is a big amount. 800 minus tax will be a small amount, na? So you are paying more tax in this case. You are paying a tax on the 40 lakhs also. Why? It's a actual expense allowed under Income Tax Act. So let the tax be deducted out of 800 and then add that non-cash expense. Treat it like a depreciation. We do the depreciation like this only, na? So 800 less 30% comes to 560 plus 40 goes to 600. Now my answer is 600, but the institute has made a mistake. Institute has taken the real tax of 231 as a deduction. Now what is the treatment of institute? I will show you. They have taken 800 profit before interest and tax, and they have added, or we can say, and they have deducted through 231 the real tax. The answer comes to 569, and then they added 40 into that, coming to the result is 609. My answer is 600, their answer is 609, and I will show you the difference. What the difference of 9 lakh is the tax on interest, which they are unnecessarily ignoring. That means they are taking more in the taxes. 231 should not be taken but the real figure will be 800 minus tax. It's very simple, sir. In this case, you are taking the benefit of tax saving on interest, and that's why your net profit is higher by 9 lakhs, because you have saved this much of the tax on interest. But please understand, the tax saving on interest is only for the equity shareholder. It should not be applicable while calculating the economic value added. In the coming questions also, in all the other question except for this, institute has made the correct treatment of doing this EBIT 1 minus tax, and in this question only they have deducted this 231 of the real tax, which is wrong. So I am not satisfied with the institute's answer of 609 in this question. You can compare the answer of this question with the questions that we are going to discuss after this, and then you will get to know about it. All in all, what I want to say is, I will just show you. When you calculate this 11.80%, when you calculate this 11, or we can say, when you calculate the profit, you deduct the tax of both. You make sure that both equity and the debt holders are paying their respective taxes. That means the interest which will be received by the debt holders is also liable for tax payment. The debt holder should also pay their tax, and at that time considering the tax saving will not be a good idea. So according to me, 609 is the wrong answer which they have taken in this, and I will go with the 600 and solve the question now. Okay, so 600 is the final answer from my side. See, this is a wrong treatment. 609 is wrong according to me. So according to my answer, it's 600, and we have to calculate the EVA, right? So what is the total? This is EVA. So we have calculated 600 minus, what is the invested capital? We will take it as 1840. 1800 plus 40 lakhs of the non-cash treatment. And now is the time to calculate WACC. We have the cost of debt, we have the cost of equity as well. Both of them has to be taken after tax. After tax. So taking this does not mean we are saving the tax. We are making sure that the debt, the long-term debt is also paying their share of tax after getting the interest. Okay. So, now is the time for WACC. It's very simple. See, understand that WACC will only be calculated on the basis of 1800. 1800 only, not 1840. So 1800 equity, this is the weight of equity into cost of equity, debt 200 into divided by 1800, and this is the weight of, this is the cost of debt, 1 minus 3. So the total will be 11.84. Now you understand, 11.84% is the expected cost of the cost of capital. This is the return that the debt and the equity holders are expecting from us. On 1840, if you will apply this on 1840, you will get the amount of return that they are expecting, and then deduct it from 600. Rest of the things are quite okay. And this question is little ambiguous, I can say. You won't find this in the next questions. So this is going to be your EVA now. It's very simple. 1840 invested capital, the required rate of return. This is wrong. This is totally wrong. This is totally wrong. Do not follow this. What they did in this part is they changed the weight. They excluded reserves from the total capital. See, they have taken 1200 here, and if I will show you, equity share capital of 1000 and long term debts of borrowings of 200. That's it. 1000 and 200, 1200. And they have ignored reserves and surplus of 600, which is totally wrong. You will not find such a treatment in the next question. So what you can do is, according to me, if you will go according to me, I will ask you to ignore that question. Unnecessary getting confused is not a good idea. We have one more question of bad debt provision, and in that question you will find that the treatment is proper. So let's move ahead. Question number 31 is again similar. It includes the patent right. Okay, so you will do it by yourself. I don't think so my help will be required. Earnings is 18.5 and the total patent has 9 years, that is 50 lakhs. Assets includes 50 lakhs of property, plant and 25 lakhs of working capital. So all of the three will constitute to the total capital of the company, and 14% is the cost of cash. So 14%, 125 is the expected. Pretty much easy question. Let's find out something good to discuss. Question number 32 is again on you. Why? I will tell you. First of all, you will calculate the cost of equity using CAPM. All the data is given in the question. Now you will calculate the cost of debt 1 minus tax. So you have calculated the cost of equity, cost of debt. With the use of, by using both of them, you will calculate the WACC, weighted average cost of capital. 165 is the total. See, 165 is the total invested capital. No confusion in the invested capital. 40 is the debt, 125 is the equity. Just divide it and you will get the weights. So this calculation is pretty much easy. And taxable income. See, this is the profit after tax, I think. Yeah. What is given in this question is profit after tax of 25 lakhs. So once you divide it by 1 minus 0.30, you will calculate profit before tax. And in profit before tax, you will add the interest to make it profit before interest and tax. You needed EBIT, na? So this is the EBIT. Now take that EBIT and then 1 minus tax. I will show you here. EBIT minus interest is equal to EBT minus tax is equal to EAT. So in this question, this figure was given, EAT, whereas we needed this one. So to reach there, we have divided the earning after tax with after tax rate. So 1 minus 0.30, 70% to reach at this point, and then added interest to reach at the EBIT. We took the EBIT, 1 minus tax, and then rest is the history. Okay, sir. Question number 33 is something where you want to learn about the prepaid expenses. See, ABC Limited has 3 divisions, A, B, and C. Acha. The division C has recently reported on annual operating profit of 20 crores 20 lakhs. This figure arrived at after charging 3 crores of the full cost of advertisement expenditure for launching a new product. Now what has been done? The benefit of this expenditure is expected to be lasted for 3 years. Now understand the situation. You made an expense whose benefit will last for 3 years, and according to accounting standards, what we should do at this time is we should allocate this expense in 3 years, not entirely in the first year of expenditure, or we can say payment. So we should divide this expense in 3 years as 1 crore, 1 crore and 1 crore. But what has happened? This figure is arrived at after charging the entire 3 crore of the full cost of expenditure. That means instead of deducting 1 crore, we deducted 3 crores from the profit, and then we arrived at this value. Now understand, if this is EBIT before this expense, we should have deducted only 1 crore and arrived at earning before tax, before interest and tax, whatever it is. But we did it like this, EBIT minus 3 as 20.20. So what is the solution now? It's very simple. Instead of 1, we deducted 3, hence add back 2. We are going to add back 2 crore rupees to arrive at the correct figure. Or if you are facing this issue of understanding in that 2 crore of the logic, you can straight away add back 3 and then deduct 1. 1 crore to is real, na? 1 crore should be deducted for the first year because it is for that year. It is relevant for that year. So we should deduct that. So 2 crore is the only figures which should not have been deducted, and that's why we will add it back. So it will be 22 crore 20 lakhs. Now the cost of capital is 11% and the cost of debt is 8%. I will assume this as a cost of equity. They want to say as cost of equity, not just the entire capital. I think they are right. It's the entire capital itself. So this is cost of capital and this is cost of debt. They are just confusing you. So we can straight away use 11%. 11% is calculated using KE and KD itself. So ignore this 8%. This is not at all relevant. The net assets of this division is 60 crores, but the replacement cost of these assets is estimated to be 84 crore. Now, what are you going to take as the invested capital? See, as per the balance sheet, if you go as per the balance sheet, 60 crore is the net assets. But if you want to replace these assets, it will cost you around 84 crore. So you will take 84 crore. It's very simple, sir. In the previous question also, we didn't follow the book value. If the patent was not added in the books, we added it separately for the economic value added, right? If there was something like bad debts, we made the adjustment of that also. So we are not following the book value. We are following the real values. And in this case, it is 84 crore. So now the question is very simple. You have to calculate the economic value added. For that purpose, what is the expected return? It's 11% on 84 crore. And what is the actual return? 22 crore 20 lakhs after adding back the 2 crores. So this is 22 crore 20 lakhs. On 84 crore, you will calculate 11% as the expected return. And the actual return is this and the EV is this. Story is over. So there are only two things to learn in this question. The first thing is the replacement cost has to be considered instead of book value, and the second thing is if there is something like prepaid expenses and if you have deducted all those in the first year itself, you should add it back because the rest of the 2 crore expense was not for this year. Cool. Question number 34 is easy. You will take that as an homework. Again, in this question, see what has been given. Profit after tax is given. So what we did is first we calculated profit before tax, right? And after calculating it, we have added interest in that. So this is EBIT and then EBIT 1 minus tax. That's it. Simple. Rest of the figures are given in the question itself. Cool. Question number 35 is interesting. We are taking only those questions where we will learn something. Something is new. Again, calculate the economic value added with the help of the following information. Financial leverage is 1.4 times. If you might have gone through the types of leverages chapter in the CA Intermediate Financial Management, then you will realize this concept. Remember this concept. See, I will tell you. Sales, if you remember this, sales minus variable expenses was equal to contribution, right? If you remember this, contribution. And once you deduct the fixed cost out of contribution, you will reach at the earning before interest and tax. And after deducting interest out of it, you will reach at EBT. Now, these three figures are important. Contribution, EBIT and EBT. When you divide the contribution by EBIT, you will get to the operating leverage. This was one of the concepts. There were three types of leverages, right? Operating leverage. When you divide EBIT by EBT, you calculate financial leverage. And when you multiply both the leverages, that means contribution by EBIT into EBIT by EBT, ultimately resulting into contribution by EBIT, that was combined leverage. So, I'm not going into detail of the operating and combined leverage, but financial leverage has this formula, EBIT by EBT. Again, let's have a look. If financial leverage is equal to EBIT divided by EBT, understand the logic. Can I write down this EBT as EBIT minus interest? Can I write it down like EBIT divided by EBIT minus interest is equal to financial leverage? Because what is the situation? I want to calculate EBIT. See, I want to calculate EBIT and I only have interest and financial leverage. So if I know the interest value and the financial leverage, I can easily calculate EBIT with this formula. That's why the financial leverage is given to you. Rest, there is no use of that financial leverage in this question. It is only used for the purpose of calculating EBIT, because we need that EBIT for economic value added calculation. So we are going to use this formula. Okay. Capital structure is like this: 170 lakhs of the equity and 130 of the reserves and surplus. Can I call both of them as equity capital? 300 lakhs. Then financial leverage is 1.4 times. Okay, and the debenture is 400 lakhs. So equity is 300 in total and the debt is 400. So total capital is 700. Cost of equity is given to us. This is cost of debt, and the income tax rate is also given. So let's first find out EBIT. Financial leverage is equal to PBIT or PBT, as I said, and we can convert this PBT into PBIT minus interest, right? Now the next part, PBIT divided by PBIT minus 40. That means interest is 40. How did you calculate? 400 lakhs into 10%. 10% on the debenture, 40. So 1.4 is equal to PBIT by PBIT minus 40. Now you can solve this entire equation and you will reach at the PBIT as 140 lakhs. That's it. PBIT is equal to 140 lakhs, and when you deduct the tax out of it, 140 minus 1 into 1 minus 0.30, this is the EBIT, not net operating profit after tax. Cool, sir. Now is the time for WACC. WACC, cost of equity is 17.5% multiplied by the weight of equity, which is 300 by 700. Am I right? Plus cost of debt is 10%, but we have to take it after tax. That means 1 minus 0.30 into 400 by 700. And this way you can calculate the WACC. Have a look. 17.5 into this, after tax cost of debt into this. The total capital is 700 lakhs, weighted average cost of capital, and 98 lakhs of the operating profit. EBIT 1 minus tax. EVA is ready. So in this question you learned about how to use the financial leverage to calculate the data PBIT. That's it, nothing else. Question number 36 is again on the same part. Again we have been given with the financial leverage. You can see 160 and 140, that is 300 lakhs. This is again 400 lakhs. The rates are different. Cost of equity is around 14%. That's it. Again, it's the same thing. You will calculate the PBIT, net operating profit after tax, and everything will be same. Coming over to question number 37 now. The following data pertains. See, income from consultancy is 935. EBIT is 180. So this is important for us. If we want to take the earnings for equity and debt now, EBIT is important. Then interest on loan, EBT, tax rate, and so and so. Now equity stock is 100, reserves and surplus is 325. So can I say 425 is the equity in total and loan is 180. So if I want to take the capital invested, this much is the capital invested, 425 plus 180. That goes to 605. Okay, then current liabilities on the other side, land and building, computer, current assets, debtors, okay. Bank, cash, okay. Now, with the following information, you are required to calculate economic value added. It's very simple, sir. You need EBIT 1 minus tax into WACC into capital employed. See, capital employed is already given to you as 12%. Sorry, WACC is already given to you as 12%. And we need capital employed. I told you capital employed is something like 605. See, 605 million, right? So you will put 605 million here, and EBIT. EBIT is how much? 180. Understand, 180 minus 35%. Do not take this 56.70 as was done in the second question of EVA. And I will show you how much is the tax here. 56.70, right? See the tax amount. This is a proper treatment. They have taken 35% of the EBIT, not the exact tax given in the answer. And that question was wrong. That's what I told you. So EBIT is 180, 1 minus 0.30. That's it. You can calculate the answer. 180 minus 30% is 126, minus 605 into 12% is 72.6. That comes to 53.40. Just a second. 180 minus 30% is 126. So, sorry, that's my bad. It's not 30%, it should be 35%. The tax rate is 35, na? So I will change my answer. It's 117. That's 44.4. Right? So what did you learn out of this? That EBIT minus a rate is a proper answer, not the tax amount given in the question, because that tax amount includes the tax saving on interest, which is wrong for economic value added. It is wrong because economic value added is calculated from the angle of the stakeholder, not just the equity shareholders. And profit and loss account is calculated according to equity shareholders. So taking the tax saving on interest in profit and loss account is right, but not in economic value added. Okay, sir. The next question is calculate the market value added. What do you mean by the market value added, sir? This is a new concept. No, it is not. It's very simple, sir. How much is the market value in addition to the book value? So, shares of the company is $50 each, right? So, one share is of $50 and total number of shares are 10 million. So, can I say the total market value is 10 million into 50, that is number of share into market price, which is 500, right? 500 is the market value of equity and 425 is the book value of equity. So how much is the market value added? Market value minus the book value. That's 75. 50 into 10 and 425. 100 plus 325. Got it? Market value added. Simple. What is the book value of the equity? Market value of the equity. The difference will be the extra value of equity in the market. Simple concept. Okay, let's come to the next question now. Question number 38. Interesting one. Following is the information of Messrs. DY Limited for the year ending 31st March 2021. Sales are given, operating expenses including interest is given to you. We don't want interest to be deducted out of the earnings, right? So 8% debentures on 250 lakhs, calculate. 8% on that comes to 20 lakhs. So if you will reduce the 20 lakhs out of these expenses, the only operating expenses without or excluding interest will be 600. Okay, so can I take 1000 minus 600 and 400 as EBIT? Yes, sir. And if you will deduct interest out of it, then it will be EBT. So 400 is important for me. That's one treatment. Now equity share capital, reserves and surplus is 250. That is 500 is the equity value and 8% debenture is the debentures value, that is 250. So can I say the total book value is around 750. 250, out of which 500 belongs to equity and 250 belongs to debt. Okay, the market value of the entire company is 900. Okay, corporate tax, this includes, it is not just the equity, this includes debt plus equity both. Corporate tax rate is 30%. So EBIT minus 30%. So can I say 400, 1 minus 30% is 280, right? Risk-free rate of return, market return and equity beta. You know very well that why this data will be used. It is for cost of equity, CAPM. You have used the capital asset pricing model like n number of times. Okay, so calculate the weighted average cost of capital first of all. Okay, let's do that. See, CAPM. By using CAPM, you will calculate this 14% rate of the cost of equity. You already have the debentures at 8%. You can take it after tax by deducting the tax rate of 30%. So 8 minus 30%, right? And what will be the weights? Sir, weights are very simple. Out of 750, 250 constitutes the debt and 500 constitutes the equity. Coming over to this point, cost of debt is after tax 5.60, and this is WACC, cost of equity, weight of equity, cost of debt, weight of debt. Already we have taken the cost of debt as after tax, so it should not be again deducted after tax in this equation. So cost of equity, weight of equity, 500 by 750. Cost of debt, weight of debt. You can clearly see 500 and 250 has been taken. 2/3, 1/3. This is going to be your weighted average cost of capital. N number of times we have used it. Now coming over to the economic value added. I told you it is 400 to 280. See, operating expenses excluding interest. So 620 minus 20 is 600 is the total operating expenses. Profit is 400 EBIT and after tax is this 280. Now calculation of the capital employed 750. Now the question is very easy. EVA, no PAT, 280 that we have calculated. 1120 and 750. No PAT is very easy. Okay, determination of the market value is also easy. Question is also saying I think about the market value. I will show you. Yes, market value. Now understand one logic. This 900 lakhs of the market value includes debt and equity. So what is the book value of debt and equity? It's 750. So either you do this 900 minus 750 because both of them includes the value of debt and equity. The only difference is 900 is the value of debt and equity, market value of debt and equity both, and 750 is the book value of the debt and equity both. So it will be like 150. Cool. Another way of calculating this is you can do one thing. 900 minus 250, 500 will be the value of equity. 750 will be the value of equity. True. And what is the book value of equity now? Let me just find out. 900 minus 250 is 650, no? Yeah, sorry. It will be 650 and the book value of equity is 500. So 650 minus 500 is again 150. So anyhow you calculate, the market value added will be 150 only. Do you understand that? See, 900 is the total value of equity and debt. Once you remove the debt value, you will reach at the market value of equity. And book value of equity is 250 plus 250. So the answer is 150. Or else you can take debt and equity both. And this is also debt plus equity both. Answer is 150 because debt is same. 250 of the debt is included here, 250 of the debt is included here. So it will automatically become 0. And what will be left is the only value of equity, market value added. Same. Okay. So this is a question from the study material which also includes the bad debt provision. And I was telling you there is one question which has a proper treatment when the bad debts provision is given for the tax. This is that question. Understand this now. Compute the EVA of A Limited with the following information. You have been given with the revenue, direct cost, selling and general administrative expenses. This is EBIT minus interest, EBT, tax expense and all. So we will take this EBIT. Am I right? 410, right? And the actual tax expense is 120. Okay, not a problem. Now on the other side we have equity and reserves of 800. So this is the value of equity shareholder and this is the value of the debt, 100. So total is 900. Now assume bad debts provision of 20 lakh is included in SGA. SGA is the selling, general and administrative expenses. That means what? We have to deduct the tax from 410 and add back 20 lakhs. Do not add 20 lakhs directly in 410. It would mean that we don't want to take the tax benefit of bad debts provision. tax benefit is allowed. So first deduct the tax and then we will add back 20 lakhs. Cool. Yeah. And the same amount is reduced from trade receivables in current assets. So 20 will be added here as well. Because it is reduced already, the second impact will go to the reserves and surplus. Also assume that the pre-tax cost of debt is 12%, the tax rate is 30. So this would mean 8.4%. Yeah, 8.4% after tax cost of debt. Cost of equity is 8.45. Okay, so for 8.45 we have 800 of the equity capital. For this we have 100 of the equity capital. While calculating the WACC, you will only take 900 as the capital, right? Okay, so computation of net operating profit after tax. You took 410 EBIT. What is the tax amount? The tax amount here is 120 and here it is 123. Do you understand the difference of this? We have not taken directly the tax expense there. Now understand, first of all, let's calculate the tax expense, the tax rate. Tax expense divided by EBT. 120 divided by 400. That means 30% is the rate. Now apply this 30% here. So 410 into 30% is 123. You can clearly see the tax is properly taken here, not just directly from the table. So that question was wrong. This is right. And add back non-cash expense 20, bad debt provision. No, net operating profit after tax is 307. Okay, then comes the calculation of invested capital 920 proper. They have calculated indirectly. Instead they could have directly taken equity, reserves and non-current borrowings. That will make 900. So equity, I will just do it. Equity, reserves and surplus 700, 100, that's 800, plus borrowings 100, that's 900, plus bad debts provision 20, that's 920. This is a proper way if you can calculate it like this. Okay. Next, WACC. You can clearly see 800 by 900 is 8.45. This is cost of equity, this is weight of equity. While calculating the weights, do not take 920 in the denominator, only 900. This is after tax cost of debt and this is cost of rest, everything is same. 8.44% applied on 920. This is the capital charge. That means this is what we are expecting the company to earn. This is what the investors are expecting the company to earn, 77.65, and what exactly they earned is 307. 410 less tax plus 20. So it's a positive EVA. I took this question just to explain that it was right. So question number 40 is your homework, because question number 41 is exactly same, and question number 41 is lengthy in answer, but nothing's new in that. So there are 3 different companies. Have a look. The following information is given for 3 companies that are identical except for the capital structure. So total invested capital, you can clearly see 1 lakh in each, but the debt asset ratio is different. Debt to equity ratio is not there. It is debt to asset ratio. That means this is the total asset. Out of this, debt is 80%, 50% and 20%. So if you want to divide it, it will be 80,000 debt, 50,000 debt and 20,000 debt. Rest is the equity. Okay. Shares outstanding, number of shares, pre-tax cost of debt, cost of equity, operating income before interest and tax. Now understand, the tax rate is 35%. You can straight away deduct 35% out of this amount to get the no net operating profit after tax, first thing, in order to calculate the weighted EVA. Now we have to calculate the weighted average cost of capital for each company. That means the same calculation to be done thrice. Acha, what is the formula, sir? Cost of equity into weight of equity plus cost of debt 1 minus tax into weight of debt. Now I will show you. Weight of the debt is 80%. So what will be the weight of equity? 20. So in this case 80-20 is the ratio. In other case 50-50 and then 20-80. Cool. Now coming up with the cost of equity and cost of debt. See, cost of equity is given. So 26% into 0.20 weight of equity. This is a pre-tax cost of debt. First of all, deduct tax out of it, 1 minus tax. So it will be 1 minus 0.35 and then multiplied by the weight of 80%. You can calculate the WACC. Similar approach in the other companies as well. See, total debt, pre-tax cost of debt and equity fund. I think that was not required. 80, 20, 50, 50, 20, 80. Okay. And this is cost of, I will show you the formula. This is post-tax cost of debt. Cost of debt, weight of debt, cost of equity, weight of equity. So we have 3 WACC. Easy to calculate. Compute the economic value added. It's very simple, sir. Whatever is the WACC that you have calculated, apply directly on the invested capital of 1 lakh. That's the expected return, and you have net operating profit after deducting 35% out of this. So we have the WACC, then EVA is nothing but they have directly calculated EBIT 1 minus tax and this. You can calculate and you will get the same answers. Okay, what's next? Based on the EVA, which company would be considered for best investment? Whichever company has the highest amount of EVA. So in this question, orange is the best company in terms of investment. Acha. If the industry PE ratio is 11 times, estimate the price for share of each company. We have to calculate the price of each company. How do you calculate the market price? It's very simple. Market price is equal to EPS multiplied by PE ratio. They have already given you the PE ratio. You have to calculate the EPS. How to calculate the EPS? Start with EBIT. Now follow. Forget about EVA. Now follow profit and loss account. Deduct interest, calculate EBT, deduct tax, calculate EAT, divided by number of share. This is going to be EPS. For the first company, like operating income before taxes, interest and taxes 25,000, right? Now you have to deduct interest on that. Interest rate is 16% on 80,000 of the debt, right? 1 lakh into 80.80 is 80,000. So 80,000 into 16% will give you the interest amount, which will be 12,800, and the balance is 12,200, out of which you will deduct the 35% tax rate, which comes to 4270, which will be 7930. Now divide the shares outstanding 6100. This will be 1.3 multiplied by 11 is the PE ratio, and this is the market price. That's 14.3. This is how you have to do for the rest of the 2 companies as well. See, 14.3. EBIT minus interest, taxable income less tax, net income divided by shares, EPS multiplied by PE ratio, you will get the stock price. Easy. Okay. Last question of this 41. Calculate the estimated market capitalization for each company. You have just calculated the market price, multiply it with the number of share, and you will reach at this value. This is something which will give you easy marks, 8 marks easily. Means if this question comes in exam, now it's a bonus marks for you, because nothing is difficult in this question. Cool, sir. Let's come over to the next question now. 42, 43, 44. We are going to finish the chapter. Now, this is an interesting question where we are going to use the geared and ungeared beta. So have a look. STR Limited's current financial year income. Just a second. Okay, so let's start once again. STR's Limited's current financial year income statement reported its net income after tax of 50 crore. Following is the capital structure of STR. Okay, debt 11% 80 crore. Equity share capital reserves and surplus 250, and the total is 330. Quite simple. Debt is 80 by 330 and equity is 250 by 330. This will be the weight of equity and debt. Cost of debt before tax is 11%. And let's have a look. Following data is given to estimate the cost of equity capital. So asset beta, we need, this is unlevered beta which is given, and you can clearly see in on the previous page debt is there in the company. So this is not going to be useful while calculating the cost of equity. You need beta of the equity, that means levered beta. We have to convert that unlevered beta into levered. We'll do that, don't worry. This is risk-free return, and please underline the word premium. This is market return minus risk-free rate of return. Okay. Tax rate is 30%. You have been given with the profit after tax of 50 crore. Once you divide it by 1 minus 0.30, you will get profit before tax of 71.43 and add back interest in that. So let me just go through that part. Acha, taxable income 50 by this 7. Acha, they have written it in lakhs, so that's why 7,142 lakhs 0.86 crore was converted to lakhs as well. And once you add the interest in that, it is 8022.86 lakhs. Now you can deduct 1 minus 0.30 in order to calculate the net operating profit after tax, NOPAT. This will be used in the calculation of EVA. Understand that. Okay. Coming over to this part, we need WACC. We have the invested capital of 330 crores, or we can say 33,000 lakhs. But we need WACC, and WACC we need cost of equity and cost of debt. We have the cost of debt as well. Cost of equity we need CAPM formula, but in that we need levered beta, and the unlevered beta is given to us. We can easily calculate that. This is a formula, but I will just revise that. Levered beta is equal to unlevered beta. Whatever we have learned in the concept is 1 plus debt equity ratio into 1 minus tax, right? This was the total. Now they have taken it like this, na? So unlevered beta is given in the question as 1.11. We will keep it like this. 1 plus, how much is the debt? 80. How much is the equity? 250. 1 minus 0.330. That's it. Debt equity 80 by 250, 330. Calculate. That's 1.3586. Let's just check it. Yeah, 1.3586 is converted into 1.36. Now use that 1.36 beta in the CAPM formula. 1.36. Calculate the cost of equity. This is cost of debt after tax. Use it here. 250 by 330, 80 by 330. This is WACC. Use that WACC on 330 crore and 8022.86 lakhs minus. See, 8022.86 lakhs minus 1 into 1 minus 30. So this is net operating profit after tax, and 17.58% into 330 crore. Please, this is my request. Never follow such type of format in the answer by the in exam. First figure is written in lakhs and the second figure is written in crores. This is wrong. This is according to the institute that I have copied here, but this is my request not to follow this different methods, lakhs and crore. Either you take everything in lakhs or you take everything in crores. And this is my request, that in this question they converted everything in lakhs. That was not at all required. If the question itself talks about the crore and crore, so you calculate the final answer in crores itself. Why there is a need for lakhs? It should have been crore only. Okay, so this is first time we are getting a negative EVA, which is a very bad thing for the company. Okay, second last question. It was asked in December 2021, old syllabus, 4 marks. It is a reverse question, reverse calculation. EVA is given to you. EVA means indirectly something is given to you and you have been asked to calculate the amount of capital employed and net operating profit after tax if WACC is 10%. So have a look. Fragrance Limited has reported net operating profit after tax, no PAT, to capital employed. See, no PAT to capital is written as like this. No PAT to capital employed is equal to, as, this is where we are separating, as 2.5% plus WACC. So it is like WACC plus 0.025. Economic value added is 4 crore as on 31st March 2021. Understand, no PAT divided by capital employed is equal to WACC plus 0.025. Cool. Now, they are asking us to calculate the amount of capital employed. Now, let's write down the formula of EVA, which is nothing but no PAT minus WACC into capital employed, right? Now, what is no PAT? No PAT can be written as, if you transfer this capital employed on the other side, no PAT will be WACC plus 0.025 into capital employed. So, can I write down WACC plus 0.025 into capital employed minus WACC into capital employed? Now open the bracket. WACC into capital employed plus 0.025 into capital employed minus WACC into capital employed. Can you understand that these two figures are common and are negating each other? That means they are getting cancelled. Positive WACC into capital employed minus WACC into capital employed. So what's left is the EVA is equal to 0.025 capital employed. And what is the amount of EVA? 4 crore. So 4 is equal to 0.025 into capital employed, and the capital employed will be 4 divided by 0.025. That's 160 crore. That's it. Okay. We have reached to the part of capital employed. Now they are asking us to calculate no PAT if WACC is 10%. It's very easy, sir. WACC is 10%, capital employed is 160 crore. This is 4 crore. How much is the no PAT? 16. It will be 20 crore. 20 minus 16 only will give you 4, na? See? 4 crore, no PAT, 10% of the WACC into 160 crore. So it will be 20 crore. It's very easy. So quite a good question now. Coming over to the last question of our syllabus of the corporate valuation. XY Limited is a cement manufacturing company. This is not the question for economic value added. You might have seen that from question number 28 to 43. It's like 28, 29, 30. 16 questions were only on the economic value added, where we have seen many varieties. Cool. X Limited is a cement manufacturing company, has hired you as a financial consultant of the XY Limited company. The cement industry has been very stable for some time, and the cement companies SK Limited and AS Limited are similar in size and have similar product market mix characteristics. So we can clearly say that these are the pure play firms for us, or we can say proxy firms or competitors. Use comparable method to value the equity of XY Limited. So basically we have to calculate the value of this company. That's it. Corporate valuation chapter it is. We are going to calculate the value of this corporate. In performing analysis, use the following ratios: market to book value, market to replacement cost, market to sales, and market to net income. We have to calculate these ratios. Understand? Market value divided by the book value, replacement value, sales, and net income. So we will have 4 different ratios for SK Limited and 4 for AS Limited, right? So every ratio, we have total 8 ratios, and then we are going to calculate the average of the ratios. So at that time we will have average of both. So we will have 4 different ratios, average ratios. Have a look. The following data is given for all the 3 companies. These 2 are the competitors, and this is what we have to calculate. The market value of the SK Limited and AS Limited is given, but XY Limited is being asked to calculate. So keep this as the basis, 450. Market value by book value, 450 by 400, then 450 by 600, 450 by 550. 450 by 18. So you will get 4 ratios. In the same way you will get 4 ratios here as well. Okay, sir. Have a look. 1, 2, 3, 4. 1, 2, 3, 4. 450, 450, 450, 450, 400, 400, 400 and 400. Market value is in the numerator. Rest of the figures are related to book value, replacement cost, sales and this. Now what you did is, these two are the ratios of market to book value of the two company. So what we did is, we calculated the average of both and applied it to our company. So this is the average ratio of market to book value calculated from the two companies. Market to replacement cost, average is this, and average is this. Now we used this average ratios on these values. Simple. These are the book value. See, understand. Market value to book value is equal to, what is the first average? 1.2290, right? So what are we going to do? 1.2290. How to calculate market value? Transfer the book value on that side. 250 will get multiplied by 1.2290. So all the ratios will get multiplied with these four figures. And then you will have four different market values, right? And you can understand that obviously all of them will not be same. But if you calculate the average of all the four, you will get your answer. See, in the last answer, these are the book values of now the company. Book value, replacement cost, sales and net income. Our company, average taken from the above table, and then we multiplied because the formula was like that. So we have four different market values and then we calculated the average of four. So 363.31 is the average. You understand that chop shop approach? It is similar to the chop shop approach. This one is the similar to chop shop approach. This is also called as relative valuation, because you find out the relative companies, calculate the ratios from those companies and apply those ratios to your company to find out the value. That's an easy question. Got it? So this was the question asked in mock test paper and in November 2019 old syllabus. Cool. With this we finished the chapter of corporate valuation, sir. Obviously it had 44 questions, but most of the questions were easy. And I told you in the beginning of the chapter itself that almost all the concepts were covered in portfolio management and the security valuation and international financial management, like Geared and Geared Beta. That's it. Couple of concepts were new, like economic value added. Rest, some of the concepts were from intermediate, like net present value, or this we can say financial leverage. That's it. The next question is going to be, the next chapter is going to be the last chapter in this batch, mergers, acquisition and corporate restructuring. We have around 60-65 questions in that. So coming over to mergers, acquisition and corporate restructuring, you can clearly see we have around 65-63 questions in that. The good part about this is going to around take I don't know exactly, but not so, formulas are not there in this chapter. You need to understand the process, operating structure, and with that operating structure we can calculate a lot of we can solve a lot of questions. But apart from that, there is one concept that I would like you to focus on, which is the maximum and the minimum exchange ratios. This is something which is very important. So we'll meet you in the next lecture with the mergers, acquisition and corporate restructuring chapter. See you, sir.